So let's continue. So I want us to do group or business combination or consolidation. So now the group aspect comes as a result of parent-subsidiary relationship, where, for example, if we have company A may decide to acquire another company. Let's call it B. Company A acquires company B more than 50% of its share to 100%. More than 50%. So assume A acquired B maybe 70%. Now the company being acquired is known as subsidiary. And in this case, the investor is known as the parent company or the holding company. Saying that in this case, the parent company acquires another company, more than half of its equity. The company being acquired is known as the subsidiary. Then, if A acquires B 70%, there is that aspect or proportion of 30% not acquired by the parent. Now, that 30% is what we call non-controlling interest or the NCI. Then the parent company might decide to invest in another company. Let's call it company C. He acquires between 20% of its shares to 50%, 20% to 50%. Let's assume, for example, now this company is known as an associate, or it can also be a joint venture. Joint venture is where you have 50-50. And then you have a joint arrangement. Then, what's the difference between then a subsidiary and an associate? We think that for subsidiary, the parent company owns more than half of the equity, or more than half, or more than 50%. But for associate, in this case, the entity acquires between 20% to 50%. Now, for subsidiary, the investor of the parent company can control it. That's the power to exercise or to control the operations B. But A cannot control C because this is an associate. For associate, the company can only exercise a significant influence. Can only influence an associate, but cannot control an associate. Now, that's all about the group aspect, where you have the parent company and the investee, where you have the subsidiary, the associate, and joint venture. Now let's look at what we call the group structures. And we have three types of group structure. One, we have what we call a horizontal structure. And for horizontal structure, this is where the parent company has more than one subsidiaries. For example, we can call it B, C, D. We are controlling B 90%. Is controlling C 80% and maybe 65%, or where all the subsidiaries are under one parent. That's what we call horizontal structure. Number two, we have what we call the vertical structure. And for vertical structure happens where we have the parent company, company A. Company A acquires another company, score is being maybe 80%. So that means this is the parent of the holding company. The holding company is controlling another company 80%. So B is our subsidiary. If A controls B 80%, that means there is an uncontrolling interest of how much? 20%. Good. Then the subsidiary decides to acquire another company. Let's call it C. B acquires the shares in C. Now, this C is what we call a subsidiary. Subsidiary. Now, in this case, the parent to C is B, but B itself is a subsidiary of another company A. So that means company A can also control C indirectly through B. So as A controls C, A controls C indirectly through B. So therefore, A control in C, you just take 80% of 90%. 80% of 90%. So that means the non-controlling interest in C by A will be how much? NCI will be an amount of 28%. Good. That's what we call a vertical structure. For vertical structure, we have a relationship between subsidiary and sub-subsidiary with its parent. Then lastly, number 3, we have what we call mixed structure. It's also known as D structure. Now, for this structure happens where company A, being the parent company, acquires another company. Let's call it B. Let's assume 90%. Who is B? Yeah, B is a subsidiary. Then the parent company also decides to acquire another company. Let's call it C. And assume it acquires 35%. Then the subsidiary decides to acquire share in the parent associate. Let's assume it acquires, for example, 20% or 25%. A is the parent company, B is a subsidiary. Who is C? Associate. Let's see if it's an associate. How does A control C? A controls 35%. Also, A controls C indirectly through who? Through B. So we have an indirect control. That's through B. As A controls C indirectly through B, it's 90% of 25%. So it's 90% of 25%. That's 22.5, right? Ownership. That is 57.5%. Who is he? Who is he? In this case, the parent has more than half of the shares. Are you together? Therefore, it's not an associate. It's a what? Yeah, it's a subsidiary. Good. So the group structure, we have the horizontal structure, vertical structure, and we have the mixed structure. Any questions so far? Yes. If the company owns another company less than 20%, that's just a normal investment and should be recognized as available for sale. Right, together. If it's less than 20%, it's not a subsidiary, it's not an associate. For being when it's less than 20%, it's just a normal investment, therefore should be recognized as part of non-current assets as an investment available for sale. Now, there is this non-controlling interest, and we say that non-controlling interest of net asset in the subsidiary, which is not owned by the parent company. NCI can be carried or measured either at fair value or at proportionate share in subsidiary net asset. Those are the two methods you can use. So that's according to IFRS 3. That's how we should measure NCI, either at or at proportionate share of the subsidiary net asset. Then let's look at goodwill on acquisition. We said what's goodwill? Have we ever come across goodwill? Yes, which topic? What are you doing? Yeah, partnership. And you see that the goodwill is just the difference between the purchase consideration and the net asset acquired. So to get the goodwill, you take purchase consideration, and this is the amount paid by another entity or the investor to acquire another company. So if A acquires B, The amount that A will pay B, that's what we call the purchase consideration. Then you compare against, so you raise net assets acquired. And you say that to get the net asset is asset minus what? Liability. So in this case, what you'll be doing, assets and liability keeps on changing in each financial year. So what happens? You use the items which does not change. For example, ordinary share capital, share premium, they only change mostly only when we have an issue of share. So in this case, we'll be taking, because we're saying that to get the net asset, it's asset minus liability, of which asset minus liability is the same as what? Capital. And capital is the same as what? Equity. So for the net asset, this case, we'll be looking at the items where you have things to do with ordinary share capital. Also have share premium. We also have pre-acquisition. Take earnings, whereas pre-acquisition reserves. Yeah, for the revaluation reserves, I mean for the revaluation reserves, other general reserves, and retained earnings, you take the pre-acquisition. Pre-acquisition, that means at the date of acquisition. Then you add the total assets, then you compute with the proportion of ownership. You take that minus that, that's how you get good. And we have two methods you can use to compute goodwill. One is the full goodwill method. Number two, we have partial goodwill method. Now, what's the difference? Now, for the full goodwill method, in this case, you compute the goodwill of the subsidiary as a whole. That means, in that case, the goodwill comprises both the parent proportion as well as the NCI proportion. But for partial goodwill, you only consider the parent goodwill in that subsidiary. So, take this scenario where company A acquired company B 90%. A acquired B. So who is B? Subsidiary, and who is it? The parent. At the date of acquisition, B had a net asset of, but A, the purchase consideration, the amount A paid to acquire B was 105 million. Now, if you're to get the goodwill, how do you compute the goodwill? If you're using the full goodwill method, you take the purchase consideration, which is 105, you raise net acquired, and B, its value was how much? 100. There's a goodwill of how much? 5. What you call the full goodwill. In that case, you take the goodwill of the subsidiary as a whole. But if partial goodwill, you only consider the parent goodwill in that subsidiary. So just take the purchase consideration, which is 105, minus the net asset acquired was 100. But of this 100, we only controlling 90%. So in short, you are, so you take 90% of that 100. Now the difference, what you get, that's what you call the partial goodwill. In this case, you only take parent proportion. The other 10% for NCI, you don't consider. But in this case, you also considered even the NCI, because for this 100, we have our 90% which you're controlling, plus the non-controlling interest of 10%. So if you take the purchase consideration, then you take the net asset acquired, you multiply by the proportion, what you get is our partial goodwill. And then you can also factor in NCI goodwill for you now to get full goodwill. Now those are the two methods you can use to compute goodwill, either full goodwill method or partial goodwill method. Good. So take out your notes now. Discuss something. So page 1, we have some definition of terms, consolidation. Then number 2, we have subsidiary. Now what's a subsidiary? You're saying that a subsidiary is an entity sold by another entity for more than 50% of its equity share. Then we have control. What do you mean by control? This is the power to govern the financial and operating policy decision of the investee. Then we have group, and then we also have non-controlling interest. And for non-controlling interest, this is the proportion of net asset in the subsidiary that's not owned by the parent company. And then IFRS 3 allows two alternative methods for determining NCI. Yeah, that's what we are discussing here. It's either NCI at fair value or NCI at the proportionate share of the subsidiary net asset. So one is NCI at the proportionate share of the fair value of the subsidiary's net asset. And number two is NCI at fair value. Then we have the group structure. I think I've explained everything about the group structure. Then there is an NB there, an NB. And it's that number one, only subsidiary is consolidated. So note that we only consolidate subsidiary. We don't consolidate what? Associate. So in this case, if you have to consolidate the financial statement, you only take for the parent and the subsidiary. You don't consolidate for the associate. Now for associate or joint venture, you account for it using equity method. I'll show how to adopt the equity method, but we don't consolidate the associate. Then, and for ordinary share capital and share premium, only for the parent is recognized. Yeah, for the ordinary share capital and the share premium, we don't consolidate. Rather, you only pick for the parent. You cannot consolidate the capital. Good. Then we have preparation of consolidated financial statement. So how do we prepare consolidated financial statement? Now, the parent company prepares a consolidated financial statement using uniform accounting policies. However, the parent needs not to prepare consolidated financial statement. Now, what are those circumstances in which the parent company is exempted from preparing group account? What are those circumstances? So now we have three circumstances where the parent company is exempted from preparing the group account. One, it's when the subsidiary or when the parent itself is a subsidiary of another company. You're saying when the parent itself is a subsidiary of another company. For example, can you take this case? C is a subsidiary. Who is the parent to C? B. So that means B is supposed to consolidate financial statement for who? But B is also a subsidiary of another company. So in this case, what will happen? C is part. So B is a child to another company, now the parent company. So in this case, B will be exempted from preparing the group account, in that its subsequent parent will prepare the consolidated financial statement. Good. So that's number one. Then number two, it's when the parent's equity or the debt are not traded in the foreign or the public market. What does it mean? If its debt or equity instrument are not traded in the local or in the public market. Sorry? It's a? Yeah, when it's a private company. Yeah, that's when you think its debt and equity are not traded in the public market. In short, it's not listed in a Nairobi Stock Exchange. So in that case, for private company, it's not a must that they have to present consolidated financial statement. And then number three, when the entity or when the company is an investment entity. Investment entity. Give me an example of an investment entity. An example of investment entity. That means the work of that company is to provide capital. What about Centum? Centum has more than 150 investments. And they usually do diversify the investment. That means they provide a capital for more than 60%. If they provide capital or they finance the project more than 60%, that qualifies automatically to be a subsidiary. And then we are saying that in this case, they operate under the principle of portfolio diversification. It means they have invested in all industries to diversify their portfolio. So in this case, this company cannot. It will be impractical for it to consolidate all the 150 financial statements, and then also taking into consideration that all those those companies are in different entities. So in that case, Centum would be exempted from preparing consolidated financial statement. In that is a what? Investment what? Investment entity. Those are the three major. That number one, when the parent itself is a subsidiary of another company. Number two, when it's a private what? Company, and then when it's an investment entity. Good. Then we have goodwill on acquisition. I think I've explained everything about the goodwill on acquisition. Now let's look at something else, investment in associate. Investment in associate or joint venture. That's under IS 28. And we say that an associate or a joint venture is an entity in which the investor has a significant what? Has a significant influence. Or when it's controlling it between 20% of its share to 50%. Good. So now let's go back to our notes. Discuss on that. Investment in associate and IS 28 and joint venture. So an associate is an entity over which the investor has a significant influence. What do we mean by significant influence? Now, significant influence is the power to participate in the financial and operating policy decision of the investee. When an entity holds between 20% to 50% of the voting power, that's the equity, directly or indirectly, it will be presumed to have a significant what? A significant influence. Good. If the voting power is less than 20%, it will be presumed to have no significant influence, and hence it will be recognized as a what? As an investment. Are you together? It recognizes it as an investment. And we say that that investment, it will take it to the balance sheet as part of what? Non-current asset. And which title? Yeah, it's available for sale. Good. Then the existence of financial significant influence by an entity is usually evidenced in one or more following ways. So how can you exercise your significant influence? Number one, representation on the board of directors of the investee. Number two, participation in the policy-making process, including dividend policy. Number three, material transaction between the entity and the investee. You find that there is that material transaction. Then number D, interchange of management, personnel, and then provision of essential technical information. Good. So those are some of the ways in which the investor or the holding company can exercise significant influence. Then how do you account for associate? Now, IAS 28 revised requires associate company to be accounted for using the equity method. Remember, we said that you don't consolidate associate. You only consolidate subsidiary. Now, for the associate, for both associate and the joint venture, they are accounted for using the equity method. How do we account using the equity method? Equity method just to purchase consideration. Cost of investment. Then you add post-acquisition changes in net asset. Then you deduct impairment loss. Now what you get is what you take to your non-current asset. You take the purchase consideration of the cost of investment, you add post-acquisition changes in net asset. And for the net asset, mostly what changes the retained earnings. So assuming company A acquired maybe 40% in B, that means B is an associate. And at the date of acquisition, the retained earnings of B Limited was 300 million. That was the retained earnings at the date of acquisition. That's what we call the pre-acquisition retained earnings. But at the reporting date, the retained earnings of B Limited is 400. That is a change of how much? 100. Then you take post-acquisition changes in net assets. So you take 100 and then you are controlling it 40%. So you take 40% of 100. That's what you get there. And then that any impairment loss of goodwill on acquisition of that associate. That's what we call the equity method. Good. So now let's go through that equity method. And this is a method of accounting whereby the investment is initially recognized at cost. Thereafter, post-acquisition changes net asset. Good. Then we have exemption from using equity method. And then we have discontinuing the equity, the use of equity method. Now, when can the company discontinue the use of equity? Let's be here. When does the company cease the use of equity method? You're saying that equity method is only used to account for what? For investment in associates, right? At joint ventures, where you're controlling between 20% of equity to 50%. But if, assuming the company had acquired another company 40%, that means 40% qualified to be an associate, right? Then during the financial year, the holding company acquired an additional 15% of the ownership. So how much is the total now ownership? 55. If you have more than 50%, that will be a what? A subsidiary. So when it becomes a subsidiary, you immediately cease the use of equity method. Now, still assuming we are controlling 40%, or we had acquired 40%, the company decided to dispose maybe 25% of the ownership in that company. So how much the residual control? 15%. That means it becomes an investment, right? So in this case, being an investment, the company immediately sees the use of what? The use of equity method. So those are the two major exemptions where the entity, the parent, exempted from using the equity method. When investment becomes a subsidiary, on when the company loses significant what? Influence. That means less than 15%. You can go through that. So the use of equity method should cease, number one, from the date the significant influence of joint control ceases. And then number two, if the investment becomes a what? A subsidiary. And then if the retained interest in the financial asset, that's the interest, is less than 20%. Then we have the joint venture. Now, how we account for joint venture and associate are the same. Actually, they are under the same standard IS 28. It's only for joint arrangement, which is under IFRS 11. But this one stipulates the accounting of different types of joint operations. So let's go through that. Joint venture. And a joint venture recognizes its interest in a joint venture as an investment and shall account for this investment using equity method in accordance with IAS 28. Then we have joint arrangements, that's under IFRS 11. And this is an arrangement of which two or more parties have a joint control. A joint control is a contractual agreement of sharing control. And you have two types of joint arrangements. Type arrangement. They are classified into two. One, we have the joint operation. Number two, we have the joint venture. What's the difference? Now, for joint operation, in this case, the parties to the contract have right to assets, and they have obligation for the liabilities. They have right to the assets and obligation to the liabilities. But a joint venture, in this case, the joint venturers or the parties to the contract, they have right to net assets. That's the difference between the joint operation and the joint venture. So let's go through. So types of joint arrangement. One, we have the joint operation. This is arrangement whereby the parties have a joint control, have the right to assets. Can you underline that? Right to assets and obligation for the liabilities. Then number two, we have joint venture. And for joint venture, these are a joint arrangement whereby the parties that have joint control have the right to net asset. Can you underline net assets? Good. Then we have forms of joint venture. So you can go through that, the forms of joint venture. want to give you 2 minutes. You go through that, what we have discussed, mostly the computation of goodwill. Let's look at the computation of goodwill. Now let's look at this transaction. Now let's be here. Specialized transaction. And number one, let's look at intergroup balances. Now for the intergroup balances comprises of account receivables and account payables. So how do you adjust for intergroup balances? Now for intergroup balances, are eliminated for both account receivables and account payables. Now take a scenario whereby company A acquired company B, maybe 90%, or assuming it's a wholly owned subsidiary, maybe 100%. So that means A being the parent, B is a subsidiary. And then during the year, they carried out a transaction whereby A sold goods to B on credit worth 100 million. A sold goods to B worth 100 million. So how do you reflect that transaction in the statement of financial position? How will A record that transaction in its financial statement? Yes? A will record it as an account receivable. B will record that transaction as an account payable. So that means in the books of A, they are showing an account receivable of 100. And then in the books of B, the account payable, they are showing an amount of 100. So you're saying that during consolidation, since we're in the same group and they are showing the same amount, what happens? We eliminate that amount from our account receivable, also eliminate from the account payable. Yeah, note that the intergroup balances should be eliminated from both account receivable and account payable. And then the two amounts should be in agreement. If in my book I'm showing an account receivable of 100, also for the transaction in your book, you should show over how much? 100. So you're saying that the amount on the same transaction should be the same. But sometimes we found that A is showing an amount of 100, B is showing an amount of 60. There's a difference of how much? 40. Now, this 40 is what we call cash in transit. That means in the financial statement of B, they were showing an amount of 100. Then A wrote a check of 40 million. That means once you read the check, the accountant adjusted that amount and they're showing an amount of 60. But 40 million, the check of 40 million has not yet been received to, has not been presented to A. That's why A is still showing an amount of 100. So that difference is what we're saying that goes to the cash in transit. So how do you adjust that? So we have said that if it was 100, it just made from account payable. In this case, from the account payable on consolidation, you amount of, you see, what account about to account payable, account receivable. The account receivable, they're showing an amount of 100. So to receivable, you eliminate that 100. Then that difference of you take it to cash in transit. Yeah, if we never recorded that, that means our cash is understated. How together? So you add it back to cash. Good. Number 2. Intergroup sales and unrealized profit. Intergroup sales and unrealized profit. And intergroup sales should be eliminated in full from both sales and cost of sales. So assuming company A sold goods to company C, goods worth 120 million. A sold goods to B 120 million, and B is a subsidiary. So how do you record that transaction in the income statement? Yes, how do you record that transaction in the income statement? Don't just look at that. That will not change. I'm asking a direct question. It's not something you're supposed to think. If A sold goods to B, how do you record that transaction in the income statement? Yeah, A record, A record a sale. What about in the books of C? Yeah, C record amount of a purchase. But a purchase is part of cost of sale. Yeah, remember when consolidating, you only consolidate the published financial statement. That's what you consolidate. And they're saying that the purchase is part of the cost of sale. So that means A recorded a sale of 120. C recorded a cost of sale of how much? 120. So how do you account for this? We are saying that intergroup sales should be eliminated in full from both sales and cost of sales. So in my sales, I eliminate 120. In your cost of sale, you made 20 because the same transaction, the same amount are in the same group. Then, if company is selling goods to company C, that means they have made a profit. They were not transferring the good. They were selling the good. The good. If you're selling the good, you have a profit what? You have a profit motive. Are you together? So that means of this amount of 120, we have what we call the profit within the group. That's what you call the unrealized what? Unrealized profit. Now, for you to understand the unrealized profit, number one, you have to differentiate between markup and margin. Margin and markup. Margin is based on what? Sales. Markup is based on cost of sales. So if you're told that A sold good to B and made a margin of 10%, A sold good to B and made a margin. You see, you are given sales and you're given the margin, eh? So that means totally direct. 10%, you just take 10 over 100. A sold good to B at a margin of 20. 100. What if now you're told that A sold good to C, A sold good to C, so you're given the sale and made a markup of 10%. I said that markup is based on cost, but you're told that A sold good, so you're given sales. So how do you link up that markup with sales? Or how do you convert markup to margin? So in case you're told that A sold good to C and made a markup of 10%, you just take 10 over 110, not 100. If it's 20%, made a markup of 20%, you take 20 over 1. If it's that, it will be of 130. A sold good to B and made a markup of a third. Convert that one into margin. Good. It will be 1 over, 1 over 4. You know what we're doing here? You're just taking this 10, you add it there. That's how you get 1 over 10. So it's a third, you just take that one, you add there. If you add 2 that, made a profit of 2 that, convert that one into markup. Yeah, you just take this 2, you add it there. So it will be 2 over 5. Good. So now, take this scenario now. A sold good to be worth 120 and made a markup of 20%. So the markup was 20%. Therefore, how much is the unrealized profit? You will take 20 over 120. You multiply by the transaction cost, which was 120. So that means they made a profit of how much? 20. So how do we account for this profit? Now, for unrealized profit, you added to cost of sales. You debit the cost, but you know about debiting and crediting. Just know you're supposed to add it to cost of sales. Then you remit that amount from the closing. Are we together? For unrealized profit, you added to cost of sales. Then you eliminate it from the closing stock. Good. But for the intergroup sales, there it should be eliminated from both sales and the cost of sales. Then number 3, we have intergroup sale of fixed assets. How do you for intergroup sale of fixed assets? Number 1, we have 2 transactions need to adjust. One, it's all about the profit on sale. And then number 2 is the overcharged depreciation. How do you account for that? So assuming you have company X and you have company Y, they're in the same group. That means one is a parent, the other one is a subsidiary. X sold an item of plant, an item of PPE to Y. Assume the cost to X, that item had cost 100. Then they decided to sell it to Y. That means assume they made a profit and they decided to sell it at 110. So that means to X, the cost was 100. Then they sold it to Y to 110. So that means to Y, its cost is how much? The purchase cost, which was an amount of 110. There's a difference of how much? Yeah, that means they made a profit of 10. Now this 10 is the profit within the group. Within the group. So we can call it the unrealized profit. How do we account for this unrealized profit? We account for this unrealized profit on sale of where you added to cost of? Yeah, you added to cost of sales. You eliminated from what? PPE. This is a sale of goods. Hi together. But this is a sale of what? Non-current assets. You added to cost of sales, but you eliminated from the PPE. Then, being an uncurrent asset, assuming the group has a depreciation policy of 10%. That's the depreciation policy of the group. So that means in the books of X, they usually show a depreciation of how much? 10. What about in books of Y, they'll be showing a depreciation of how much? 11. There's a difference of how much? 1. In 10%, and this difference arises as a result of this profit they made? They made 10% of this profit they made of 10. You get how much? 1. Now, this one is what we call the overcharged what? Depreciation. And for overcharged depreciation, how do you account for it? It's the opposite of this. That means you debit or you add it back to PPE. You eliminated from what? Yeah, cost of sales. Yeah, we're saying that for this profit on disposal of PPE, you add it to cost of sales, you eliminate it from the PPE. Then for the overcharged depreciation, you add it back to PPE, you eliminate it from the cost of sales. I want to give you 3 minutes. This is all about consolidation. Are you together? In case you didn't understand anything here, so I assure you will float the entire class. And this is a mandatory question must be tested. And if you're able to get just these 3, the intergroup balances, intergroup sale and unrealized profit, and intergroup sale of fixed asset, will be good to go. So let me give you a few minutes. Look at that. Now let's do an illustration. September 2015, question 1. September 2015, question 1. So number one, we are told that on 1st October 2014, P Limited acquired 60% of the equity share capital of S Limited in share exchange of 2 shares of P Limited for 3 shares in S. P acquired S 60%. If we acquired 60%, who is S? Subsidiary. And we have an uncontrolling interest of 40%. And then we acquired them in share for share exchange. So that means in this case, the purchase consideration was in form of what? The issue of share? Issue of share. And what are the terms? In a share exchange of 2 shares of P, 2 shares of P for 3 shares in S. Remember, it's P acquiring S. So that means for every 3 shares you acquire, you pay them through the issue of your own 2 shares. Let's go to the balance sheet. How many shares did S have? Go to the financial statement, the balance sheet. S had how many shares? Eight. I'm not asking about the share capital, I'm asking about the shares. Have you understood my question? I'm asking how many shares did S have? Now, I'm not asking about par value. I'm asking about the number of shares. How many shares do we have? 2,000. 800. 8,000. That's called the mark approach. Do you know what's called mark approach? Mark approach. The one is by the lawyers. You are confident in something, but they will make you believe what you're saying is wrong. It's called mark what? Mark approach. Now, you are saying like a chorus. How many shares do we have? 8,000. Then I played my question. I'm asking about the number of shares. Then you casted doubt, and then you start giving wrong answers. We have 8,000 shares. It's just 8,000 you divide by 1. You get how many shares? 8,000. What was that? So we had 8,000 shares. That's what S had. But they only acquired 60% of the equity. Are you together? So of 8,000, P Limited acquired 60%. 60% of that is how much? 4,800. Now we want to determine the purchase consideration. For every 3 shares in S, they are issuing 2 shares. Are you together? So for every 3, they issue 2. Or about 48. They issued how many shares? So X will be 2 times 48. That is 96. 96 divided by 3, you get 30. That's 2. So they issued that 2 shares for it to acquire S. Then you are told that on this date, the shares of P Limited were trading at 8. We issued that 2 shares and our shares was valued at 8. So how much was the purchase consideration? An amount of 25,600. That was the purchase consideration. That means for P to acquire S, it's paid or issued shares worth 25,600. Then let me take you back on what we're discussing on our last session. We see that ordinary share capital are recognized at what? Par value with the balance taken to the share premium. So what do you take to the ordinary share capital? What do you take to the share premium? P issued that 2 shares. The ordinary share capital, issue them or recognize it as the par value. How much is the par value per share? 1. But the market price was how much? 8. So there's a premium of how much per share? Good. That 2. What about this? 22? 22,400. Good. Below are the financial statement of the 2 companies for the year ended that 1st March 2015. Can you underline that March 2015? So that means if the year ends on that 1st March 2015, when had that financial year started? 28. 1st of April 2014. Then let's read the question again. On 1st October 2014, now that's when we acquired S, on 1st October 2014, and the year ends on that 1st March 2015. That means how many months to the end of the year? How many months? 4 or 6? 6 months. So now that means S has been a subsidiary for only 6 months? 6 months. So that's very important point. Now you are given the income statement, then you are given the statement of financial position. Additional information. The issue of share on acquisition of S does not yet by P Limited. Then number two, as at the acquisition date, the fair value of S assets were equal to their carrying amount, except for an item of plant, which had a fair value of 2 million in excess of the carrying amount. What we said was carrying amount? Net book value. This item has 2 million in excess of the net book value. That's what we call revaluation. We had a revaluation gain, an amount of how much? 2 million. Then you are told that the plant had a remaining useful life of 5 years at the acquisition date. So that means we need to present our depreciation. There was an other charge depreciation. Is 2,000. This item of plant had an estimated economic life of 5 years. So how much depreciation? 2,000 divided by 5 you get 400. But it has been a subsidiary for only 6 months. So you want to take depreciation for 6/12 and you get an amount of 200. How do you account for this expense? You take it to cost of sale, then you eliminate it from PP. Good. Being an expense, you add it to cost of sales, then you eliminate it from plant, property, and equipment. Good. Number three, we are told that sales from S to Patterson Limited, that's what we call intergroup sales. And we are told that sales from S to P, S sold to P. The subsidiary sold back to the parent. That's what you call the upstream sales. Sales from S to Patterson Limited in the post-acquisition period amounted to 8 million. So the intergroup sales was 8 million. We say that for intergroup sales should be eliminated in full from both sales and the cost of sales. Then you are told that S Limited made a markup of 40%. So therefore, how much is our unrealized profit? You take 40 over 140. Then you multiply by shillings 2 million of this good at cost on P Limited are still included in the inventory on that 1st March 2015. Of this intergroup sale of 8,000, they still hold 28. Now let's be here. The intergroup balances was 8,000. Are you together? So by then, P Limited had sold an amount of 5,200. And the remaining is how much? 28. So of this 28, the profit is not yet realized. It's within the group. But for what they sold, they already realized profit. So for unrealized profit, is you take that the markup, you multiply by the closing stock. Closing stock. How much is it? 400 times 2. Is it 800? 800. How do you account for this 800? We say that for unrealized profit, you added to cost of, you eliminate from the closing stock. Good. Number four. S limited trade receivable include. What is that? Or intergroup balances. You said intergroup balances are about account receivable and account payable. And you are told that S limited trade receivable include 800,000 due from P, which did not agree with the corresponding payable. S P. Account receivable, let's be here. S receivable, an amount of 100. That P payable, it should be also showing an amount of how much? It should be 800. But we are told that it never agreed. Why? Then we are told that S limited trade receivable include 800 due from P limited, did not agree with the corresponding payable. Why? This was due to cash paid by P limited, which is yet to be received by. So that means P limited paid this amount. Therefore, the balance is how much? But that amount has not been received by S. So that cash in transit. Good. Number five. P limited as a policy of accounting for any non-controlling interest at fair value. The fair value of goodwill attributable to non-controlling interest of S limited was 2.4 million. We compute goodwill. And whenever you're given NCI goodwill, that means use the full goodwill method. Number 5 is goodwill. How do we get? You said you take. How much was the purchase consideration? Not there, it's here. The purchase consideration was how much? It was 25,600. Then you compare again. Net asset acquired. And you see that to the net asset acquired, you look at the equity items. Now let's go to the equity. The equity elements, what do we have? We have ordinary share. How much is the ordinary share capital? You have? I just need ordinary share capital. 20? Kumaanisha mjui Kenya tunatafuta. We are looking goodwill on acquisition of who? Subsidiary. So kindly leave out the ordinary share capital of the parent. You go to the subsidiary. Yeah, we are. You see, what? Acquired in S limited. How much is the ordinary share capital? 8,000. What else do they have to the equity? Retained earnings. How much of the retained earnings? Very low. We say that for retained earnings, you take the pre-acquisition. Yeah, we say that for retained earnings and other reserves, we take pre-acquisition retained earnings. So how much was it? Sorry? It's 13,000. Now let's be here. Why should I do it? Okay, let me just do it as part of the workings here. You are given, now give me what you have in your balance sheet, the retained earnings. It's 13? It's 13,000. But that is as that 1st March 2015. But you say that you take the pre-acquisition retained earnings. So pre-acquisition, that means we acquired them on 1st of August, 6 months to the end of the year. 1st of August. August in mwezi wa? Was it August or October? October. Mwezi wa 8, 2014. October ni mwezi wa 10, eh? Are you sure? October, August, eh? First, when the financial year started? On 1st of April. Mwezi wa? 4, right? Good. 20? Yeah, 2014. Yeah, kindly don't confuse me with the month name. Eh? I only know January, February. No, even March sometime, it will confuse me. January, February, November, December. And then August. I know August, but August sometimes confuses me. August and October. Eh? So now, for 6 months to the end of the year, we are looking at the pre-acquisition retained earnings. So how can we determine that amount? Let's go to the income statement. So you'll find the income statement for the year. During the year, they made a profit of how much? Good. They made a profit of? During the year, they made a profit of 6,000. Then the income statement, we assume items accrue evenly. So if they made a profit of 6,000 during the financial year, that means for the 6 months, they made a profit of 3,000. And this one, they made a profit of? Now, can someone give me the retained earnings at the rate of acquisition? Yes, I don't know what you're computing. It should be 10. So just take 13,000. You eliminate the profit they made during that period of 6 months, which is 3. That means at the rate of acquisition, how much was the retained earning? 10,000. You deduct 3,000. So that means at the rate of acquisition, we had an amount of 10. And also we had a revaluation. Yeah, you remember S, revalued an item of branch at how much? It's a revaluation gain of 2,000. So how much of the net asset? 8, that is 20,000. Of 20,000, the parent only acquired 60%. 60% of 12 is that is 12,000, right? Give me the goodwill. That is 13,600. Then that was a goodwill, right? Can we add NCI goodwill? Are you given the NCI goodwill? Yeah, let's go to note number 5. Number 5. P Limited has a policy of accounting for any non-controlling interest at fair value. The fair value of goodwill attributable to non-controlling interest in S Limited was how much? You add 24. So how much was the full goodwill? That is 16,000. Let's go to the required. Required? Or number 6. Number 6, we are told that neither of the company declared dividend in the year ended that 1st March 2015. Required. Consolidated statement of comprehensive income for the year ended that 1st March 2015. And number 2 is a consolidated statement of financial position. So in this case, who will consolidate the financial statement? P. Yeah, P is the parent. So there it will be P group. Don't write P Limited. Are you together? P group. Consolidated statement of comprehensive income for the year ended that 1st of March 2015. Let's go to the income statement. Just copy what we have. What do you have to the income statement? Yeah, we have revenue. Then you raise cost of sales. You get what? Gross profit. Revenue for P was an amount of? Yeah, you take 170,000. Then you take for S, which is 84. But this 84, it was a subsidiary for only 6 months. So you take 6/12. In short, you are taking half of it. What about cost of sales? You take 126. You add that 2,000. Is it okay? Good. Anyone is not getting where you're getting that 2,000? Who? Then we said that you add, let's be here. We add this revaluation, depreciation, you added to cost of sale an amount of 200. You also add, we say that for unrealized profit, you added to cost of sales, you eliminated from the closing stock. So you add 800. Then we minus, we say intergroup sales should be eliminated in full from both sales and cost of sales. How much was the intergroup sales? How much was intergroup sales? You know, you're used to me pointing for you everything, eh? 8,000, 8,000. This was intergroup sales. Can you see it now? S sold to P, an amount of 8,000. So 170, take out your calculator. 170 plus 42 minus 8. 126 plus that 2 minus 7. You just minus 7. Just trust me. 1? Good. You're confirming where 7,000 is coming from. Eh? What do you get? That's 53, right? Good. Once you have the gross profit, now you can deduct expenses. We have distribution cost. We had administrative expenses. We also have finance cost. For distribution cost, you take 4,000, you add 2,000. Then for admin, you have 12,000. You add? Yeah, for those who are not getting what I'm doing, yeah, I'm taking for S limited, but for S was for 6 months. So I'm taking 6 over 12, which is a half, right? Yeah, I'm just taking the half of that. Then for finance cost, we have 600 plus 400. 4 plus 2, you get 12 plus that 2, you get 6 plus 4, you get. Then give me the profit before tax. 53 minus 22,200. 23. This is 22,800. You get that 800, right? Then you less tax expense. How much was the tax expense? 9,400. You add 1,400. 9, 10, 1,800. That's 10,800, right? Just say yes. Are you confirming? that one you get 20,000. 20,000. That's the profit after tax. Now, once you have the profit after tax, you need to show attributable to. Number one is what you attribute, and the other one you attribute back to the parent. That's the profit. But in this case, remember, we consolidated the subsidiary. So how much do you attribute back to the NCI? NCI, we are controlling a percentage of? NCI is? You take 40% of the profit after tax. How much is the profit after tax? I'm talking about the profit after tax of the other subsidiary. They made a profit of 6,000, but of 6,000, you only take for 6 months? 6 months. 3,000, right? Now let's be here. The profit is 3,000. But of this 3,000, S divided an item of plant by 2,000, right? That means they had not yet accounted for this depreciation of 200. Do you expect the depreciation to increase or reduce the profit? Increase the profit? Decrease. So you deduct depreciation of 200. S, that's the subsidiary, sold good to P. And they made a profit of how much? And yes, profit of how much? Now that profit is already included in this 3,000. Are you together? You eliminated 800. So 3 minus 2 minus 8, you get 2,000, right? 2,000 times 40%, you get 800. What do you attribute to the parent? This I will get to the parent. You made a profit after tax of 20,000. Then you attribute back to the NCI an amount of 800. How much do you attribute back to the parent? 19? It's just 20 minus 8. So the balance is what you attribute back to the parent. Any point you have not understood? I repeat. Good, no point. Let's go to number B. P group. We present financial statement of financial position. Consolidated statement of financial position as at the 31st of March 2015. So our shillings are in millions. We have the assets. What do we have for the assets? We have non-current assets. The current asset we have PPE. What do you have to PPE? 60, 900. You add 18, 9. Note that the balance sheet you don't. You see, this one is at the end of the year. All together is as at. This was for the year. To the income, to the balance sheet, you don't attribute or you don't apportion. Even if we accord it 1 month to the end of the year, you don't take 1/12. Right together. Yeah, to the balance sheet at the end of the year. Then you add 2,000, you minus 200. Give me that. Yes, try to answer why you get 2,200. This depreciation of an item of PP, then there was a depreciation of 200. Yes, 81,600. Just be confident with the answer. Investment property. What's an investment property? Held for sale. That is 26,600, right? 26,600. Then we had an aspect of goodwill. How much is goodwill? 16,000. Let's go to the current asset. What do we have to the current asset? For the inventories we had 12,080. You had 5,000. What do you get? Yeah, that means we are forgetting to adjust something. Let's be here. We say that for unrealized profit you added to cost of sales. You made from what? Closing stock. You made an amount of 800. 17,080 minus 800. You get 16 to 8. Then after inventory, you have, yeah, receivables. How much do you have to receivables? 11,920. You want 4,900. You eliminate? Yeah, you are not sure. 800. Give me that. 11,920 plus 41. 60. 60. Are you sure? 020. 16. 0. What is this 800? It's not cash in transit. We are intergroup balances. Are you together? Good. Let's go to bank. What do you have to a bank? 8,000 you what? 33, that's 11,300. Then you factor in cash in. Yeah. The one you have deducted from account was not cash in transit. That was intergroup balances. Are we together? Good. Then cash in transit was an amount of 800. Yeah. P wrote a check of which S has not yet received. So that means the cash in P has been unstated. So you have to show it there. Let's go to equity and liabilities. Equity and liabilities. To the equity and liabilities, what do you have? Ordinary share capital. How much is the ordinary share capital? You have 20,000. You add what? You add that too. Remember, you see that for ordinary share capital and the share premium, you only take for the parent. Are you together? You don't consolidate. So you take 20,000, but on acquisition of S, they issued ordinary share capital of that 200, which there was share premium of 22,400. So you add that too, and you get 23,200. Then there was an aspect of share premium, an amount of 22,400. Then you factor in retained earnings, and then you factor in the non-controlling interest. Let's go to the non-current liabilities. What do we have to the non-current liabilities? Yeah, we have 10% loan note. To the 10% loan note, we had 6 plus 8, you get 14. And then we have current. The current liabilities, we have trade payables, an amount of 12,300. You add 70,50. Any other adjustment? 12,30, 17. 19,350, right? Any adjustment here? We have intergroup balance, an amount of 800. We are supposed to eliminate how much? We don't eliminate anything. Are you together? You see, in this case, it was already adjusted. It was supposed to be in harmony, 8,8, but it never balanced. Why? Because they had already paid that amount. So the balance is it? So the account payable is already adjusted. Account payable receivable is one which was not adjusted. Good. Then we have accruals. 41. You add 2350. Vivian, what do you get? 456. 6450, right? Good. Now, what have we not computed? NCI and retained earnings. Let me show how to compute retained earnings. You take parents' retained earnings. How much is the parent retained? Sorry? 70. Then you add investee share of post-acquisition retained earnings. Investee share of post-acquisition retained earnings. From the date of acquisition, how much was the retained earnings of S? Now let's be here. Let me not stress you. We are controlling them 60%. For the 6 months, here it is. From the date of acquisition up to the end, they made a profit of 3,000. So that's the post-acquisition retained earnings. You take that 3,000 or 6,000 divided by 2. But you need to adjust this 3,000. What do we need to adjust? Okay. This is what we adjusted here. Are you together? That S Limited revalued its item of plant. And you're supposed to provide a depreciation of how much? 200. Depreciation will reduce the profit. Then S sold goods to pay and made a profit of how much? Which was already included in this 3,000. You eliminated that 8. 60% of 2,000. Is that 1,200? 6 times 2. Is that 1,200? Good. How much retained earnings? That's 72. Yeah, so retained earnings is 72. And then we have NCI. How do we compute non-controlling interest? Now, for non-controlling interest, you just take the net asset of that subsidiary. And to the net asset, let's go to the equity. What do we have to the equity? Ordinary share. Ordinary share capital, how much is for S? 8,000. We also have retained earnings. How much is the retained earnings? 13,000. But of this 13,000, this is S. Are you together? There was a depreciation of how much? 200. There's an realized profit of how much? 800. So 13 minus 1,000, you get 12,000. Then there was valuation. They revalued an item of plant. There was a revaluation gain of how much? 2,000. How much is the total? That's 22,000, right? Now, of this 22,000, we are controlling S 60%. Therefore, how much is the non-controlling interest? 40. We are looking at NCI. You take 40% of that. 40% of 22,000, you get 8,800. Then we had NCI Goodwill. How much is NCI Goodwill? Note number 5. Ruth, how much is it? 2.4 million. You add 2.4 million. 8, 9, 10. Is it 11,200? Why are you quiet? Yeah, just a free advice, eh? Because that silent does not sound good. Eh? Retained earnings, NCI, Goodwill. Leave them to John Mark. Are you together? Yes. Just work on the rest, leave the 3. Not unless you are that smart. Eh? Yeah, because high chances, actually, to be honest, high chances you'll get a wrong answer for retained earning and NCI. And in this case, we had few transactions. We shall do other question where you have a transaction and you have to interpret those transactions how it's supposed to be interpreted. For example, in this case, you see if assuming it was P who sold to S, the argument should be different. Are you together? The same if the revolution was the other company, the argument should be will be different. And if you just cram this, they're used to cram. Eh? In an exam, you just get a wrong what? A wrong answer. You don't have to waste your time computing retained earnings and NCI, and sometimes the goodwill. Just work for the rest. Give me that. Is it balancing? Hey, let me have some people to do that. Or do you want me to do it offered? I can. You say I can only see one person computing. Others are pretending. Give me the assets. 168. What about the equity? 610. 168. 600. Can I give you an assignment? No, I should not give you an assignment. So now, kindly, before we meet next, kindly go through this question again. Are you together? But before we go through this question again, go back to how we compute goodwill, but that one is irrelevant, mostly on the specialized transaction, the first 3 we did. Intergroup balances, intergroup sales, and unrealized profit, and intergroup sale of fixed asset. Then in our next session, we shall be doing more questions on this.